Okay, if you're buying it for $200,000, right? That's your purchase price. What will the lender lend you on that $200,000 purchase price?
So the first thing we do is we want to know what's the property worth when renovated and how much will it take to get there. That's the first thing we want to figure out. And that's going to determine what's called our ARV, which
After repair value.
Right, which the acronym stands for is after repair value. If we come up with a $400,000 after repair value, generally we're most comfortable lending up to 65% of that, right? So what winds up happening is the following. Now we go to contract price. Well, most people say, well, that if you can lend 65% of it, why don't you lend all of it? Because we don't. There has to be a down payment on contracts.
Skin in the game.
Yeah, you said it best.
Gotta have some skin in the game.
You have to. People, because it's very important, because on any partnership, we don't mind taking on the great brunt of it, but there has to be some sort of equal partnership, and your equal part of it is putting up your portion of the down payment. It keeps them motivated to go with. So if we took this $200,000 and you put 10% down, you have a base loan of now
180.
Now comes the repair portion. So we know you have a base loan amount of $180,000. We'll now say, how much does it cost to fix? How much costs to fix this property, Lance?
Let's say it's $50,000.
$50,000?
Let's say
Should be a little more than that for that price.
let's say it's $80,000.
$80,000. We're gonna take that $180,000, and now we're gonna tack on the $80,000 to repair it. Okay, that loan, that $80,000, generally, and I want people to understand, it's set aside in a construction reserve. And that money, you only pay interest on that money when you draw it. So it is a very inexpensive option to have an $80,000 credit line kind of waiting for you.
That's exactly what it is. It's a credit line waiting for you after you purchase. So let's just run through the numbers one more time. So you purchased the property for $200,000. That's your contract price.
Correct.
You put 10% down on the $200,000. The lender lends you $180,000. You have $80,000 that you're going to need to do construction on the property.
Right.
The lender also lends you the $80,000. So now in total, you're into the property for $260,000 of borrowed money. $80,000 of that of that money is being held in a construction reserve for you to pull draws on. What draws are as you do the work, the lender comes out and checks and verifies, and they release the funds for the work as the job progresses. Usually it's a 2 or 3, sometimes a 4-step process, depending on how often you want to pull money from the lender. And you only pay interest on that credit line when you use it. So if your first draw is only $20,000, $80,000 is allowed to you. You only pull 20. You're only paying the interest on that 20. Once you borrow 40, you're paying interest on the 40,
right.
and so on, so forth, and so on. So you've literally financed $260,000 of the project that has a value of $400,000.
That's right.